Hello everyone. Welcome to One More Thing. I'm Matt. In today's world, many people aspire to become wealthy and financially independent. One way to achieve this is through investing in the stock market, real estate, or other asset classes. While investing can be a path to wealth creation, it can also be a path to financial ruin if not done properly. In this video, we will explore the investment strategies of billionaires and the common investment mistakes they avoid. By learning from their successes and failures, we can improve our own investment decisions and increase our chances of success in the market. Investing like a billionaire requires discipline, patience, and a long-term mindset. It also requires avoiding common investment pitfalls that can derail even the most promising investments. So, sit back, relax, and join us as we dive into the 15 investment mistakes billionaires avoid, and how you can apply these principles to your own investment strategy. 1. Not having a clear investment strategy. Not having a clear investment strategy is a common mistake made by novice investors. Without a clear strategy, investors may end up making impulsive and emotional investment decisions that can lead to significant losses. A clear investment strategy is essential for achieving long-term financial goals and avoiding costly mistakes in the market. Billionaires understand the importance of having a clear investment strategy. They have a well-defined investment plan that outlines their goals, risk tolerance, and investment approach. This strategy helps them stay focused on their long-term objectives and make informed investment decisions. 2. Failing to diversify investments. Failing to diversify investments is another common mistake made by investors. Investing in only one or a few assets can lead to significant losses if those assets perform poorly. Diversification is essential for reducing risk and achieving long-term investment success. Billionaires understand the importance of diversifying their investments. They spread their investments across different asset classes, industries, and geographies to reduce risk and maximize returns. By diversifying their portfolio, billionaires can weather market downturns and take advantage of opportunities in different markets. 3. Overreacting to market volatility. Overreacting to market volatility is a common mistake made by investors. Market fluctuations can be unnerving, and investors may be tempted to make impulsive investment decisions based on short-term market movements. However, reacting to market volatility can lead to missed opportunities and significant losses. Billionaires understand the importance of remaining calm during market volatility. They recognize that market fluctuations are normal and that short-term movements do not necessarily reflect the long-term prospects of an investment. Instead of making impulsive decisions, billionaires take a long-term approach to investing and remain focused on their investment goals. 4. Ignoring fundamental analysis. Ignoring fundamental analysis is another common investment mistake made by investors. Fundamental analysis involves analyzing a company's financial statements, industry trends, and competitive landscape to determine its intrinsic value. By ignoring fundamental analysis, investors may miss important information about a company's potential and make uninformed investment decisions. Billionaires understand the importance of fundamental analysis. They conduct rigorous analysis of companies and industries before making investment decisions. By understanding a company's fundamentals, billionaires can identify undervalued assets and avoid overpriced investments, leading to long-term investment success. 5. Chasing the latest investment fad. Chasing the latest investment fad is a common mistake made by novice investors. Fads are usually short-term phenomena that can create a lot of hype and excitement in the market. However, investing in a fad without proper research can lead to significant losses. Billionaires understand the dangers of investing in fads. They are focused on long-term investment success and avoid investing in assets that have no sustainable competitive advantage or intrinsic value. Instead, they invest in businesses that have a proven track record of success and long-term potential. 6. Focusing solely on short-term gains. Focusing solely on short-term gains is another common investment mistake made by investors. While short-term gains can be tempting, they often come at the expense of long-term investment success. Short-term gains are usually driven by market fluctuations and can disappear just as quickly as they appeared. Billionaires understand the importance of focusing on long-term investment success. They take a patient approach to investing and are willing to hold on to investments for years or even decades. By focusing on long-term gains, billionaires can benefit from compounding growth and achieve significant investment success. 7. Not understanding risk management. Not understanding risk management is another common investment mistake made by novice investors. Investing always involves some degree of risk, and not understanding how to manage that risk can lead to significant losses. Risk management involves identifying and assessing potential risks and taking steps to mitigate them. Billionaires understand the importance of risk management. They have a clear understanding of the risks associated with their investments and take steps to minimize those risks. By managing risk effectively, billionaires can protect their investments and achieve long-term investment success. 8. Investing in what you don't understand. Investing in what you don't understand is another common investment mistake made by novice investors. Without a clear understanding of the investment, investors may not be aware of the risks involved or the potential for long-term success. Billionaires understand the importance of investing in what they understand. They conduct thorough research and analysis before making investment decisions, and focus on industries and businesses that align with their areas of expertise. By investing in what they understand, billionaires can make informed investment decisions and achieve long-term investment success. 9. Failing to monitor investments. Failing to monitor investments is another common investment mistake made by investors. Once an investment has been made, it is important to monitor it regularly to ensure it is performing as expected. Without monitoring, investors may miss warning signs of potential problems or opportunities for improvement. Billionaires understand the importance of monitoring their investments. They regularly review their portfolios and make adjustments as needed to maximize returns and minimize risk. By monitoring their investments closely, billionaires can take advantage of opportunities and avoid potential losses. 10. Letting emotions drive investment decisions. Letting emotions drive investment decisions is another common investment mistake made by investors. Emotions such as fear, greed, and anxiety can cloud judgment and lead to impulsive investment decisions that may not align with long-term investment goals. Billionaires understand the importance of keeping emotions in check when making investment decisions. They take a rational and disciplined approach to investing and make decisions based on data and analysis rather than emotions. By controlling their emotions, billionaires can make informed investment decisions that align with their long-term investment goals. 11. Not learning from mistakes. Not learning from mistakes is another common investment mistake made by investors. Every investor makes mistakes, but failing to learn from those mistakes can lead to repeated errors in judgment and significant losses. Billionaires understand the importance of learning from mistakes. They view mistakes as opportunities to learn and improve their investment strategies. By analyzing their mistakes and taking corrective action, billionaires can avoid repeating the same errors and achieve long-term investment success. 12. Following the crowd. Following the crowd is another common investment mistake made by novice investors. It can be tempting to follow the herd and invest in assets that everyone else is investing in. However, investing based on the actions of others, rather than on sound analysis and research, can lead to significant losses. Billionaires understand the dangers of following the crowd. They take an independent approach to investing and make decisions based on their own research and analysis, rather than on the actions of others. By avoiding the herd mentality, billionaires can identify undervalued assets and achieve long-term investment success. 13. Timing the market. Timing the market is another common investment mistake made by novice investors. Attempting to time the market involves trying to buy and sell assets at the right time to maximize returns. However, market timing is notoriously difficult, and even professional investors struggle to consistently time the market successfully. Billionaires understand the dangers of timing the market. They take a long-term approach to investing and focus on the fundamentals of an investment, rather than short-term market movements. By avoiding market timing, billionaires can avoid significant losses and achieve long-term investment success. 14. Overconfidence in investment decisions. Overconfidence in investment decisions is another common investment mistake made by investors. Overconfidence can lead investors to make investment decisions without proper research or analysis, resulting in significant losses. Billionaires understand the dangers of overconfidence in investment decisions. They take a disciplined and rational approach to investing, conducting thorough research and analysis before making investment decisions. By avoiding overconfidence, billionaires can make informed investment decisions that align with their long-term investment goals. 15. Investing without a margin of safety. Investing without a margin of safety is another common investment mistake made by novice investors. A margin of safety refers to the difference between the intrinsic value of an investment and its market price. Investing without a margin of safety means buying an asset at its market price, without taking into account its intrinsic value. Billionaires understand the importance of investing with a margin of safety. They conduct thorough research and analysis to determine the intrinsic value of an asset and compare it with its market price before making investment decisions. By investing with a margin of safety, billionaires can protect their investments and achieve long-term investment success. In conclusion, there are several common investment mistakes that novice investors should avoid. Billionaires have achieved investment success by taking a disciplined and rational approach to investing, avoiding these common investment mistakes. It is important to conduct thorough research and analysis before making investment decisions, investing in what you understand, managing risk effectively, and focusing on long-term investment success. Avoiding short-term gains, following the crowd, overconfidence, and market timing. And investing with a margin of safety are also key to achieving long-term investment success. By learning from the mistakes of others and taking an independent, rational approach to investing, novice investors can avoid these common investment mistakes and achieve long-term investment success. With the right mindset and approach to investing, anyone can achieve financial freedom and secure their financial future. Thanks for watching. Please like, subscribe and sharing. We will bring you more valuable videos. See you next time.